Hello and welcome to Connected with Latham, where we discuss ideas, legal developments and business trends shaping the global economy. I'm Rob Moulton, a financial regulatory lawyer and partner in Latham & Watkins' London office. In this episode, we're going to discuss the key topics and trends for UK financial services firms to look out for in the year ahead, based on questions you've been asking us last year. To discuss these topics, I'm joined by my colleagues from the London office, Nicola Higgs and Becky Critchley. Nicola is a partner and Becky is a counsel in the financial regulatory practice here in London. Nicola, Becky, welcome to the podcast.
Hi, Rob. Great to be here.
Hi, Rob. Thanks for having us.
Let's start by reflecting on last year. Can you describe it in a word or two or a sentence?
Well, I'll go first, Becky, and I'm going to pick multifaceted, because I think life as a regulatory lawyer is often a bit of a swing game between when are our clients really busy on transactions and we play a role in supporting them on those transactions, and when is the reform cycle pumping, or when is the enforcement cycle all-encompassing. And you tend to flex your strengths in those areas more so or less so on any given year. When I look back at 2025, it was all guns blazing across all of those different cycles. So we saw a lot of consolidation in the financial services sector, predominantly in asset management, but starting to see more broker-dealer consolidation. We started to see a lot more activity in capital markets and, excitingly, some pipeline of financial services IPOs to look forward to. And at the same time, we were fully fledged post-Brexit mindset and focused on the UK regulatory reform agenda at the same time as dealing with some material enforcement actions. So I'm sure that our colleagues in the legal and compliance functions of our clients felt that their skill sets being flexed in as many ways as we did.
And what do you think, Becky?
So I'm going to pick up one of the words that Nicola said, I think twice, which is reform. And that really is the biggest piece of 2025 for me. We've seen, I think, now the trickle-down effect of the last couple of years' rhetoric in relation to competitiveness and growth, and that being a key part of the regulatory reform agenda. And we're now starting to see the key proposals for change across the board, wholesale, retail, in the EU and the UK. I think in the last month, we've published at least 5 client alerts on actually concrete proposals that are coming in the pipeline. Every speech from someone at the FCA is talking about a deregulatory agenda or a new piece of legislation that is coming through. And so clearly that is a really important piece of the puzzle for all of those things Nicola was talking about and how that will affect all that pipeline work that's coming through this year.
So you both mentioned regulatory reform, and that's the area where we have had the most questions last year from clients who want us to cover that as a topic in this podcast. So just looking back to the July Leeds Reforms announcement, where do you think this has got to, and what are the headline changes, Nicola?
So I think one of the key things we've noticed is there's been a real recalibration of the risk associated with the way the government and regulators think about financial services in the UK. And some of the areas where we might have thought historically that the FCA or the government are, almost sort of the world leading or the most robust regulators on certain topics have now been recalibrated through a new lens, and that lens is the competitiveness and growth agenda. And so if we just think of some examples in that context, heavy focus on retail markets. The FCA has always given itself a lot of kudos for being heavily focused on the protection of retail markets. Of course, it still is, but it has been focused on areas where the retail markets experience friction. And, for example, where do we see that friction playing a role in the growth of capital markets? Another area would be SMCR. A few years ago, we would have seen the FCA very focused on the fact that it has, the world-leading regime for senior managers and accountability of individuals, probably to some extent trying to compete with the US ability to bring enforcement action against senior managers. It's now recognizing that that plays a part in growth and may detract some people from setting up business in the UK. So it's trying to some extent, harmonize that regime through a risk lens so that it doesn't perform a restrictive function in the context of growth. And then the third limb is probably in the context of the prudential requirements for banks, where we're now seeing policymakers have another closer look at really what is risk and are they properly regulating for that in the UK in modern times rather than post-crisis.
Becky, which reform items have caught your attention?
Rob, I think the focus of regulation has changed since we last talked about this. And before Christmas, we had the FCA's Regulatory Initiatives Grid published, which sets out their priorities for 2026. But I think the really interesting ones for me over the course of last year were consumer duty in wholesale markets. So that, again, is the FCA trying to be competitive and saying where consumer duty might have overstepped the mark in wholesale markets, not necessarily needed to protect retail customers. And so there might be a rowing back of obligations for wholesale firms in that sector, which has been quite a big push to do. But also linked to that is the general review of the handbook to see where that principles-based approach to regulation that consumer duty takes might be able to be read across to other areas of the handbook to make the FCA, again, that more nimble regulator, but also to give firms a bit more bandwidth to take tailored approaches rather than a strict rules-based approach.
So my perspective is this isn't really the FCA watering down rules because they never should have been implemented in the first place. It's more that we are in a different place geopolitically today in 2026 than we have been over the last 5-10 years. So we're no longer focused on purely harmonising with Europe in the pre-Brexit environment. In order to really achieve our competitiveness and growth objective, we have to leverage the fact that the UK built its reputation on being a fantastic English-speaking, time zone convenient place to do business. And therefore, the FCA and the government have had to look at barriers that people might face to doing business in the UK. So I think the focus is far more on being internationally aligned than trying to unnecessarily dilute our legal or regulatory framework for financial services in the UK. And we're seeing that more in terms of the proactiveness that the UK government and the FCA is taking in terms of interaction with global regulators, actively placing its staff in other jurisdictions, including the US, including Australia, and shortly in Singapore, focusing hard on building recognition regimes where they can. The early seeds of that are being shown in the Berne Financial Services Agreement with Switzerland, and also, establishing a new concierge function within the Office for Investment. So financial services firms have a way to kind of access UK government, UK regulators, and look to establish business here.
And so what about you, Rob? What do you see as the key headline changes from last year?
Well, I think as a package, it's hard to move for me away from things happening in primary markets where really major changes were made, and remuneration where really major changes were made, deep, impactful, in fairness, probably quite long-standing as well. They're measures that have been moving for several years and has sort of come to a culmination in 2025. I wonder whether in this year we will get to see the same scale of delivery on some of these topics. My fear is that we'll look back at 2026 as a year when the government's focus somewhat moved on because they think that the industry and the regulators have been told what to do and are doing it. The ball is rolling. It won't need as much government pressure to keep things moving. And that could lead to some of the measures being watered down or coming through in a slightly damp squib way. So examples from me from last year on that would be short selling regime, where I think much more could have been done to look fundamentally at the regime, or at the back end of last year, the minor tweaks around the definition of an elective professional client, where there's lots of detail about whether or not a tick box or a signature is a better way to get that we really don't need. That's more of a regulatory mindset than a growth and competitiveness mindset. So I'm hoping that this year the government will remain as engaged as they need to be to make sure that these measures stay on course. So on deregulation, it seems like we might be in different cycles in different parts of the world. What do you think, Becky?
So we've definitely seen a spate of EU law where the EU has been the first lawmaker in certain things in the market. So EU AI Act, EU ESG ratings regulation, and in relation to some of the more granular ESG requirements, for example, in relation to CSRD, which is really the opposite of a deregulatory agenda. But then we have just seen at the end of 2025 the omnibus package which came out, which tried to row back on certain of those requirements or delay implementation dates so that those certain pieces of law could be reviewed. And that was in response to feedback that there was over-regulation. So what we might see over the coming of this year is a sort of a levelling off at EU level and maybe a bit more on the deregulatory agenda there. I think AI regulation is a great illustrator of the differences across jurisdictions. So we have no new financial services specific rules in the UK on AI. We have some state level rules in the US, and obviously we have the EU-wide EU AI Act. And for the UK regulators, that makes sense. We've repeatedly heard that they've pointed to their existing rules, which cover AI risks, and they've left responsibility to firms to figure things out, particularly recognising that by the time they made rules, things would be stale because AI moves on so quickly. And I think that's a really good example of why the UK is taking the right approach here, with a sort of principles base pointing to rules that already might cover broad risk-based areas without having specific legislation. And that then feeds into the parts of the deregulatory agenda where the UK wants to be leading the pack, particularly in relation to things like AI.
And what about the US, Nicola?
Yeah, so I think it's a really interesting point of contrast, Rob, in terms of what we've seen from a deregulatory perspective in the US, which has been obviously driven by a change of administration and far more extreme and headline grabbing to some extent than what we've seen certainly in the UK and the EU. And some principal headlines in that context were, of course, the overturning of the Chevron defence, meaning the courts could no longer defer to a regulatory agency's reading of vague laws, and also the major questions doctrine, which demand clear permission from Congress for any rule with big economic or political effects. So I think what we've seen in the US is now effectively a very high bar to justify big bang reform, to justify new rulemaking, and by no means that our regulatory colleagues sitting in the US have been twiddling their thumbs. They've certainly been very busy, and there's of course more informal channels for the agencies to deliver their guidance in the US, but they've gone in a different direction to kind of big bang reform and rulemaking as part of their deregulation agenda.
And I feel like it's interesting just in the UK, looking back and reflecting on what you've said, that last year our own terminology changed. We were probably a year ago talking about deregulation. At some point in the middle of the year, we were talking not about deregulating, but about upgrading our regulation. And we've gone through a phase of balancing, talking about competitiveness with protecting clients, being back on the agenda. And I feel now as though most of the terminology in the UK is about reducing the administrative burden of being regulated rather than on reducing the number of regulations. Mm-hmm. Reforms might be aimed at reducing reporting burdens rather than changing the rules that the reporting is based upon. And that feels like a more stable state, but not one that's entirely in sync either with the EU or the US in their approaches. Talking about staying on course, we've had quite a few questions on the ESG landscape. It's going to be very important this year, a number of measures in hand. What do you think, Nicola, are the key differences between UK approach and EU approach, and how are clients trying to navigate that?
Yeah, it's a great question, and it's continued to be a focus of ours throughout 2025 and into 2026. So ESG is just an inherently global topic. Financial services firms are often global in terms of their footprint, and ESG needs to be thought about both in terms of a physical footprint and a revenue footprint. And so when countries and regulators diverge in terms of their expectations on ESG, that forms quite an inherent headache for firms to have to deal with. But focusing more specifically on that point around the UK and the EU, very simply put, whilst they're very closely aligned in terms of their ambition for the sustainability agenda, what they want to achieve in terms of everything from net zero, enterprise level reporting, product level reporting, that the EU has undoubtedly been much more ambitious in terms of the overall package of measures and the timing for implementing those measures. And so, we talked about divergence, we've talked about reform, but firms are now having to navigate packages that look and feel very similar, but that are being implemented at different times. And more specifically in the context of the EU, what we have had to see is the EU forcing ahead with very ambitious packages that it's now had to row back on. I'll give you two examples in that context, one at enterprise, one at product level. So enterprise level reporting, CSRD, highly ambitious package of corporate sustainability reporting. It's now been deferred in terms of timing, drastically rowed back on in terms of the number of data points and how far down your supply chain you have to look to create those data points in that reporting. And likewise, SFDR, product level reporting, just undergone a big revamp. A lot of firms are going to be focused on that throughout 2026 and coming far more into focus with what we see in the UK under the SDR proposals. And so the UK, by comparison, has sort of bided its time and as a result actually has produced a much more pragmatic set of rules that the EU has been forced, probably with some embarrassment, to come back into line with.
So, Becky, what do you think the key challenges faced by firms are?
As Nicola touched on, it's really rare in the context of financial services policy to see regulators diverge materially on trends of macro significance. And we really have seen this in the context of ESG, and more notably in the US, where most of our clients have a footprint. Part of it comes down to just how broad the definition of E, S, and G is. And it covers a whole plethora of material topics, from how diverse your board is to what your social impact is on your community. Whether a country has the will or ability to prioritise any of these topics can depend on where it is in a particular economic or political cycle, or both, or even where it's located geographically. And the associated sustainability challenges which are then most pertinent to it. And obviously that changes and evolves over time. And our globally situated clients will often tell us that running their internal ESG programs has become something of a crisis management firefighting situation, being reactive to the changing sentiment of governments across multiple meaningful areas of their business.
And so, Nicola, what do you think we have in store for the year ahead?
Well, piggybacking on Becky's point, ESG trackers are the request du jour from clients to try and keep on track of all of the different global developments and navigate the risk that they face. But we also have a really exciting pipeline of reg reform that we're looking forward to assisting clients on in the UK ESG agenda. So in a few days from now, we will see the FCA's consultation on its sustainability reporting standards. That is the UK FCA's attempt to align with the broader ISSB standards, and again points to the UK being focused on international alignment. That will initially apply to public companies, but we expect a lot of our financial institution clients that aren't themselves listed to be very focused on it in terms of direction of travel and to align their reporting globally. So looking forward to seeing that paper drop. And then I think the other key area that we'll be very focused on is in the context of ESG ratings. So the EU proposals on ESG ratings will take full effect in the middle of this year. There are live applications to ESMA at the moment for ESG ratings providers. Concurrently, in the first quarter of this year, we will be finalising the responses to the FCA's consultation, and then firms will have to think about how they're going to build their policies and procedures for ESG ratings to align with both of those two regimes.
So let's pivot to enforcement, where we've had a number of questions. What are the trends? What are we seeing at the moment?
So last year, I think, really was the year for financial crime enforcement, and CAS have been the main trends for 2025. It's clear that the enforcement team at the FCA are very active, but as they put out in some of their papers around the changes to the enforcement regime, they really are focusing on a smaller number of high quality fines in the key risk areas across their portfolio. And I think we will continue to see that throughout this year.
So, Nicola, my favourite question has been, what should I do to stay in my regulator's good books this year?
Speak to your legal advisors.
And?
Wow. So one of the trends we're watching really closely is the FCA Enforcement Division talks a lot about, exercising more of its kind of supervision data-led resources in the context of its enforcement investigations. And we often think about whether that should change the approach that we have to open and cooperative correspondence with regulators. Clearly, that's a regulatory obligation. It's a duty. We can't circumvent that duty in any way. But we do have to be a little bit more mindful, I think, about what we are telling regulators and making sure we're presenting kind of clear, precise data to them up front, if that data is going to be consumed potentially in the context of broader, longer term enforcement action. So I think in general, thinking about all stages of your regulatory engagement and making sure that you're sort of best foot forward, both on the supervisory side and of course, to the extent you're ever in any pre-enforcement investigation.
And so, Becky, do you think that FCA is improving its enforcement processes?
I think it is, and that is shown in maybe the smaller number of fines we're seeing, also the smaller number of Section 166s when we look at the FCA data coming out of that. And look, it's clear, and we've heard it time and time again, that they don't expect firms to comply with every rule all of the time. The regulators get that the rule books are long and complex, and there is an art of the possible here. But what they do expect is that firms are sophisticated enough to spot where there is material non-compliance and to act on it quickly and not letting those issues roll. And I think we will see that come out in the FCA enforcement processes, where enforcement becomes out of those types of issues, not spotting a material issue and not acting on it quick enough, rather than there being an issue which firms have, which really I think will become much more BAU for firms to have an issue, to talk to the FCA about it, and for it not to result in enforcement.
I agree with that, Rob. And what do you think in terms of your practical experience working on enforcement investigations last year? Are we seeing in practice an alignment between how the FCA are running investigations and the rhetoric around wanting to enable firms to progress through enforcement much more quickly?
Yes, I think we are, both because fewer cases are open, which enables greater resource to consistently be applied to trying to come to a settlement with firms, and because of all the encouragements that exist in order to settle early. And we've seen things like PRA rule changes to try to achieve that. And I think the FCA has now realised that the main risk to its reputation on enforcement isn't that it loses a case, it's that it spends too long winning one, and therefore it needs to bring cases promptly so that it doesn't face the challenge to winning a case that witnesses might not still be around, or the ridicule as to how long it took them to win it. So I really see that focus as symbiotically helping this point that's always existed, that it's better for firms to try to settle if they can, but it's only possible for them to do so where the FCA is taking the same approach with a consistent team that isn't changing on the ground. And I think we're seeing much more of that playing out in some much earlier settlements as a result.
And I guess one other point connected to that in terms of enforcement trends is the fact that the FCA is being a little bit more thoughtful about the cases it's bringing. Does that put paid to probably one of the most controversial themes of this trend that we all had to grapple with last year, which was its proposal to announce enforcement investigations at an early stage? Becky, what do you think the practical reality of that's going to look like in 2026?
So we didn't see a material uptick in those early announcements in 2025. We might see some more in 2026. There was a really interesting judicial review case a firm brought against the FCA's decision to announce, which was dismissed. So perhaps giving the FCA some comfort on that point, that it was right to take a decision on early announcement. So it doesn't seem like the FCA is going to be doing that with every enforcement action, because we haven't seen it. And then perhaps it's taken on that feedback around the impact that will have on the market and on firms and on shareholders. It'll be interesting to see what the statistics look like on that when we talk about this next year.
So to round this off, I'd like to ask each of you for a prediction. I'll give mine last. What do you think will happen this year in the world of UK financial services regulation, Nicola?
So I'm going to pick up on the exciting topic of resourcing. And so just picking up on all of those themes that we've picked up at the very beginning on how multifaceted the demands on all of our time are these days. But also, I think, on divergence more broadly, in the fact that you can't necessarily operate European-wide expertise from your London offices anymore. I think there's going to be a lot of focus by regulators on whether buildings and teams are appropriately resourced for the jurisdictions of operation. And so how many people do you have in your German bank versus your London bank? Do you have the right expertise? Can you cover the full waterfall of regulatory reform that you're seeing in the UK in addition to the EU? Because you can no longer run those as parallel projects.
I'm going to choose AI, and I'm going to choose that in the context of we will see the much greater use of firms using AI in some really innovative ways, as well as the regulators using it. We already know that they do that. I think that will significantly increase over the course of this year. But I think what will be interesting to see is how firms invest in the governance, risk management, compliance training frameworks they have for AI, what they ultimately end up looking like, how they look different across firms, how they look different for firms with retail and wholesale customer bases, how they look from an FCA and a PRA perspective, and whether we hear anything else from the regulator on what they expect in terms of AI. I also think it will be interesting to see whether there's anything enforcement related to AI. So perhaps if there's a piece of AI kit that goes rogue, whether that has an impact on market stability, customer outcomes, or on firm stability. And we might see some FCA enforcement action there, whether it contributes to something in a different context. Again, that will all build into the picture that we don't at the moment have of AI governance from what the regulators really expect of firms, but where we are seeing them sort of continue to take this principles-based approach to AI and saying it fits within the existing rule book. So I'll be really interested to see what happens over the course of this year in AI.
And so mine is MAR related. I think that the UK will finally review MAR. I don't think primarily for the purpose of looking again at the definitions. I think we're probably stuck with those. But for looking at the processes, the record keeping requirements, the market soundings regime and so on. And in particular, the scope. Because last year, the consultation proposal on transaction reporting said, we only want reports on UK listed instruments because they're the only ones we investigate. And it would make sense, therefore, to shrink the MAR scope to match. And that's my this year's prediction. Nicola, Becky, thank you for joining me today.
Thanks, Rob. It's been a pleasure.
Looking forward to the year ahead. Thanks both.
Yes, there's a lot for firms to think about this year. And thank you for listening to this episode in our Connected with Latham podcast series. You can subscribe and listen to new and archived episodes of Latham's podcasts on lw.com, Apple Podcasts, Spotify, or wherever else you get your podcasts. And if you'd like more information about the topics in this podcast, please email us from the links located in the show description. We hope you'll join us again next time.
This podcast is provided as a service of Latham & Watkins LLP. Listening to this podcast does not create an attorney-client relationship between you and Latham & Watkins LLP, and you should not send confidential information to Latham & Watkins LLP. While we make every effort to assure that the content of this podcast is accurate, comprehensive, and current, we do not warrant or guarantee any of those things. And you may not rely on this podcast as a substitute for legal research and/or consulting a qualified attorney. Listening to this podcast is not a substitute for engaging a lawyer to advise you on your individual needs. Should you require legal advice on the issues covered in this podcast, please consult a qualified attorney. Under New York's Code of Professional Responsibility, portions of this communication contain attorney advertising. Prior results do not guarantee a similar outcome. Results depend upon a variety of factors unique to each representation. Please direct all inquiries regarding the conduct of Latham & Watkins attorneys under the New York's disciplinary rules to Latham & Watkins LLP, 1271 Avenue of the Americas, New York, New York, 10020. Phone number 1-212-906-1200.